We had a lot of fun preparing this webinar for you guys. I'm Suzanne, and I've got with me Sam, Stacy, and David, and we are all part of the tax practice here at Saltmarsh. And we are here to debunk some common tax myths. If you guys could take a look at your chat, there is some housekeeping items in chat. Just high overview. Put questions in chat if you want to ask any. Everyone is muted except us, and hopefully this will go off without a hitch. So, like I said, we had a lot of fun coming up with this webinar, and during election, as you guys know, there's a lot of chatter in the social media world, and everyone has become a social media CPA, and there's lots of opinions going around and lots of advice going around about CPA things. And so we thought, hey, let's put together some of the most common myths that we see on social media and let's talk about them. And so we decided to have the theme of our webinar be Ferris Bueller's Day Off. And there's really no rhyme or reason as to why. We just loved the movie and thought it might be a fun way to run through some topics that we hope you guys will find interesting. So first off, this was the 10th highest grossing film of 1986. Fun fact about Ferris Bueller's Day Off. And if you haven't seen it, I don't know why, but go watch it because it's a great movie. Again, 10th highest grossing film. I was surprised to hear that was pretty high up. So what we're going to cover today is just a few high level agenda items here, just uncovering the truth behind some common tax myths. Again, they've been rampant during this whole election season, and so we're here to clear up the air. Understand some potential tax updates coming up. Again, election season, new administration. What does that mean? What's possibly going to come into effect very quickly, and what's fact or fiction? And so that's our last topic is learn some smart fact-based tax strategies. Instead of consulting Facebook, please consult us with your questions. So one thing I just wanted to note, if you are a Facebook warrior, taking tax advice off the internet can be very bad for you. It can be very misleading. One person's situation is not everyone's situation. And so you may see someone say, oh, I did this, or I did that, or this is a really good idea. You should try this. It may work for that person's situation, but it may not work for you or your business. So it's really important to consult an advisor on whether or not that potential tax strategy or myth is really true and can it be applicable to your personal situation. And so just a reminder on that it's not the same for everyone. All right. So as you guys know, in the movie, Ferris Bueller wakes up and says, you know what, today is a beautiful day. I don't feel like going to school today, so I'm going to ditch school. So he fakes being sick and decides he's going to plot his entire day out. And so he starts with his parents here, overlooking him, wondering if he's going to be okay. He's faking pretty bad. And so the first myth we're going to attack is that if, in fact, his mom had worked from home that day, she's a realtor, if she had worked from home that day, maybe his whole plan would have been foiled because she would have been at home. And so relating it to one of the tax myths we hear a lot is that you can deduct your expenses when you work from home. So Stacy is here to talk about that specific myth.
Right? Yeah. So working from home has been it's a great opportunity for parents to have more flexibility, to keep those kids in school and make sure they're leaving the house, right? But unfortunately, there's not a whole lot of people that can deduct those expenses due to the IRS regulations. So first off, the Tax Cuts and Jobs Act of 2017 eliminated unreimbursed employee expenses. So if you have a W-2 and you're working from home, you're not eligible for this deduction. So now we're carving out just the self-employed people. The next criteria that you have to go to is the home office has to be your primary place of business. So if you have another office location that you can go to, then you're not eligible for this deduction. So if you can cross that hurdle, the next one is that the area in the home has to be used exclusively and regularly just for business. And so if you're able to meet these requirements, so if Katie decides to give up her office job and just work from home and qualifies for these expenses, then she can take a pro rata portion of her mortgage expense or real estate taxes, utilities, maintenance for the home as a deduction. But unfortunately, in this case, Katie went to the office, Ferris stayed home sick, and from what I understand, he's also getting some of his friends involved in that as well, right, Suzanne?
Yep, absolutely. So, as you know, if you've seen the movie, he convinces his friend Cameron, who has massive anxiety, to skip school, and then he also convinces his girlfriend Sloane to skip school. And so the excuse that they give for Sloane, because she's actually already at school when all of this is going down, Cameron he manages to catch before going to school. But Sloane is already in school, so they fake a grandmother's death, and they get her out of school with the fake grandmother's death. So that leads us into one of the other myths that we hear quite often, is that individuals who receive gifts and inheritance are taxed. And so the question here is, should Sloane's grandmother have passed, would she have to pay tax on a potential inheritance from that grandmother? So David is here to clear that one up for us.
Thanks, Suzanne. So yes, that's a very common question that we get here at Saltmarsh when individuals, parents pass away or grandparents pass away. If I get an inheritance, is that taxable to me, or is if I receive a gift during the year, is that really taxable to me? And in general, gifts and inheritance are not taxable. There is one small exception for inheritance, I'll get into, but gifts that you receive are not taxable, and inheritances that you receive are not taxable, meaning that you don't include it in your taxable income on your 1040 that year. Now, the individual, someone that provides a gift or gives you a gift, they may have to file a gift tax return, which is a Form 709, if they give you a gift more than $19,000, if it's just from them, or if it's from from your parents, let's say, and they can give up to you up to $38,000. That's called the annual exclusion. They don't have to file the gift tax return. If it's above that amount, they may have to file a gift tax return, and because they file a gift tax return, they would be using what's called a lifetime exemption amount. So everyone has a lifetime exemption, and that amount for 2024 was 13.66 million. In 2025, it's going to be 13.99 million. And you may be asking, why didn't they make it 14 million? I don't know why, but it's 13.99 million. And everyone gets to use that up during their lifetime before they pay what's called estate and gift tax. So if they were to make a very huge gift above, let's say, $14 million, then that person would then file a gift tax return and probably pay tax up to 40% on that gift. So, but the recipient would not have to pay tax from an income tax perspective. So I will point out there's one big difference between receiving a gift and receiving an inheritance. So when you receive a gift, the tax basis in that gift is carried over from the person that gave it to you. So for instance, if they're gifting you stock or if they're gifting you a house, the tax basis that you get in that stock or house is the same as what they purchased it for. So for instance, a house might have been purchased for $125,000. Now it's worth $700,000. They filed a gift tax return, but your basis in that house is now $125,000, which means if you sold that house like the next day, you're going to have a pretty big capital gain on that house. But if you had received that house upon an inheritance, it would get stepped up basis to $700,000. And if you sold it the next day, you will not have a gain. You may have a small loss. So that's the big difference between a gift and an inheritance. One thing to point out, when you get an inheritance, you're going to have earnings on that stock. You could have dividends. You could have cash accounts that you got inheritance on, have interest. So those are going to be taxed to you going forward. And finally, a traditional IRA is where a lot of people will inherit what are called inherited IRAs. They'll inherit an IRA from their parents, let's say. So that is taxable to them because it was created in a tax deferred manner. So when they receive it, when they receive distributions, those distributions will be taxed at ordinary income rates. So if a spouse gets it, it's most likely over their um, their expected life for the spouse. If a child gets it, it's going to be over 10 years. So they're going to have to take out that money over 10 years. So that's when those amounts are taxable, when it's an inherited IRA and they get a distribution. So, now that Sloan has been picked up from school, I believe they're going to Chicago. Is that right, Suzanne?
They are. So they have now, Ferris has now convinced Cameron to steal his father's 1961 Ferrari GT 250, which, as a fun fact, only 56 were made, which explains why Cameron was very hesitant to take this car away from his father's house. And they're on their way downtown Chicago. And so they decide to go to Chez Key, a very upscale French restaurant downtown. And they can't get in because they don't have a reservation. And so Ferris sneaks a peek at the reservation booklet and sees that Abe Froman, the Sausage King of Chicago, has a reservation. So he pretends he is Abe Froman. And that brings us to another myth that we hear, and this is probably the one I personally hear the most, is that Abe Froman and his Sausage King company probably don't pay any taxes. We hear that, at least I hear that a lot, is that, Abe Froman and the Sausage King company, they don't pay any taxes. And so Sam is here to tell us if that's in fact the case or not.
Thanks, Suzanne. So the difference between a quote unquote rich person who maybe looks like they don't pay taxes versus someone else is the fact that this person or the corporation is getting the benefit of other losses or the tax benefits listed here that we'll go through. So in this scenario, we'll compare Abe Froman, who is at this restaurant, and another person at this restaurant, just a high earning W-2 employee. So on the employee side, he just has W-2 income that's going straight to him. He's filing a tax return and assuming maybe he has over $500,000 or $1 million of income, he's going to be reaching that top 37% tax bracket. And he's not really taking any tax benefits in this scenario. Whereas on the left side, we have Abe Froman. He has lots of businesses, lots of sausage franchises. He has financial investments, as well as perhaps some W-2 income. So while he is getting income passed through to him from his businesses, he's also perhaps getting some losses passed through to him that offsets that income. And he's also probably taking some of the cash sitting on hand and investing that back into those businesses. So from on his side, he is, of course, probably at $1 million of income as well, reaching that top tax bracket. And he's also probably going to be subject to net investment income tax if he has a lot of financial investments going on. But he's going to be able to take the benefit of depreciation deductions from his businesses. Perhaps they have sausage carts and he can depreciate those carts. He might be able to take benefits from other tax credits if he has a foreign business, if any of his businesses have research and development credits or renewable energy, any type of tax credits could get passed through to him. He'll also be receiving a beneficial 20% tax rate on capital gains from his financial investments. And again, I mentioned this, but if he's using some of his cash from those businesses to invest back in the business, that could be coming through as an expense. And any pass-through income would be subject to the qualified business income deduction, further reducing Abe Froman's personal income tax liability. So can we go to the next slide? So now we'll talk about a fictional corporation who is a cruise line. And so for this cruise line, Parade Cruise Lines, they've been in operation for a while. And theoretically, in this 2024 year, they're getting the benefit of things business and economic activity over the last few years. So one thing that businesses can benefit from is a net operating loss deduction from prior years. So this cruise line, obviously in 2020 during the pandemic, was not operating. They were just having massive losses with their boats sitting out in the water, losing money left and right. That net operating loss deduction they're able to utilize in 2024. They also in 21 expanded their operations from US only to include international, and therefore they've been subject to tax in foreign jurisdictions. So they're getting a foreign tax credit passed through to them that will reduce their US income tax liability. And then, say in 22, they started a research and development project related to some type of new cruise technology. They'll be able to take benefit of the R&D tax credit. And finally, they started developing a private cruise port, and that allows them to take a bunch of depreciation deductions in 2024 when those are placed in service. So all these different activities of the business and different economic experiences that they've gone through have created what looks like a really beneficial tax position, but then we can see that this is kind of just a shifting of timing, like with the losses in one year benefiting them in future years, and the tax credits are benefits provided under the Internal Revenue Code to kind of incentivize businesses to do R&D and for depreciation. So yeah, now that we are done at the restaurant, what?
Off to the ball game.
Yeah, now we're gonna go to a baseball game.
So fun fact, Matthew Broderick was not the first person they asked to play Ferris Bueller. It was actually a guy named, I think, Anthony Hall, who I'm sure is kicking himself daily for not taking this role. But he turned it down because he was too busy with other projects. And I don't know about you guys, but I don't even know who that guy is. So I don't know that that was a good call. But I also thought this was fun, that other people planned possibly for this role that they considered were Johnny Depp, George Clooney, Tom Cruise, Michael J. Fox, and Jim Carrey. So I thought that was kind of fun. But the second person they asked was Matthew Broderick, and of course he obviously accepted, which was great for his career. So again, don't know what kind of mistake that guy Michael made, or Anthony Michael made, but it wasn't a good one. So yes, they are off to the Cubs game now. And this is another myth that we hear a lot is, well, corporations, they don't pay any taxes because they get to deduct all of these fancy boxes, and they, are taking their clients to, Tahiti all the time, and, all of these different things. And that's why they don't pay any taxes. And so Stacy is going to talk to us about whether or not we can deduct entertainment expenses.
Thanks, Suzanne. That's right. So, unfortunately, what you're seeing out there, entertainment, it is not deductible. So those skybox rentals, the theater tickets, the hunting lodge trips, it's not deductible. In addition, if you have any meals that are considered lavish or extravagant, it's not deductible either. The IRS hasn't really defined that. However, it's just something to be aware of. That you would want to look at, what is considered normal in your industry. And also, if you're having drinks at a bar or a nightclub, it's not really conducive to a business connection. So those types of expenses are not deductible either. And sometimes when we go to an event, there might be meals that are served at that event. And so the IRS does allow in certain circumstances for you to deduct the cost of the meals that are served at an entertainment facility if those expenses are separately stated on the invoice. If it's part of the overall package, then those meals are also considered entertainment and not deductible. So some items that are deductible, however, are what I would consider pure business meals subject to a 50% limitation. So it must be ordinary, meaning that it's something that's generally accepted in your trade or business or profession. It must be necessary, which the IRS defines as helpful. There also must be some sort of a business connection, whether a discussion, meeting agenda, some sort of other event. Also, you must keep proper records of the meal and the discussion that took place. And lastly, you need to be present at the meal or have one of your representatives present there in order for it to be subject to this limitation. There is a bright shining star. We're in holiday season right now. You are allowed to deduct 100% of a holiday party or other social or recreational activity for your employees, as long as the primary reason is that it's to benefit your non-highly compensated employees.
Nice. All right. Well, meanwhile, back in economics, we've got Mr. Lorensack, and if I'm going to do this right, we're all going to mute.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the, anyone? The Great Depression, passed the, anyone? A tariff bill, the Hawley-Smoot Tariff Act, which, anyone, raised or lowered? Raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression. Today, we have a similar debate over this. Anyone know what this is, class? Anyone? Anyone? Anyone seen this before? The Laffer curve. Anyone know what this says? It says that at this point on the revenue curve, you will get exactly the same amount of revenue as at this point. This is very controversial. Does anyone know what Vice President Bush called this in 1980? Anyone? Something DOO economics. Voodoo economics.
All right. Well, speaking of presidents, as you probably heard if you were paying attention to anything during the election, is that Trump stated at one point in time that tariffs would replace the individual income tax. And so we hear that a lot. Is that actually going to happen? Is that speculation, or is that part of his policy? So David here is going to unpack this one for us.
Suzanne, sorry to say that tariffs will probably not replace individual income taxes. I think that it would be very difficult to deconstruct the individual income tax regime that's been around for decades. So I think it is unlikely, and I think that's the general consensus that it's unlikely. However, there are proposals that President-elect Trump has set that he would like to see implemented into tax law, and some of those benefit, and a lot of them will benefit individuals. So the first set are really what we call the extension, or right now there are tax law that was created with the Tax Cuts and Jobs Act in 2017, starting in 2018, and these are part of his proposals. The first one was to continue the reduced tax rate tables. I think everyone's benefited from those tables being lower tax rates. The continuation of the increased standard deductions. So before 2018, standard deductions were about half of what they are today. And then the last one would be continuation of the qualified business income deduction, which is what individuals that receive pass-through income from partnerships and S corps, they get to take a deduction, a 20% deduction on their individual income tax returns. Now, these are all set to sunset or go away starting in 2026, but we do think there's a lot of momentum to put these into law. One thing I previously mentioned about the lifetime exemption. I remember there was a lifetime exemption about $13.99 million for 2026. that is also expected to sunset starting in 2026 down to about 7 million. So that's a big difference between 13.99 and 7. But that's another one where we think there's a lot of momentum to be able to extend that and keep it going forward. His second set of proposals are sort of like new proposals, so to speak. The first one common one is no tax on Social Security, no tax on tip and overtime income, a reduction of the maximum capital gain rate to 15%. Right now it's 20%, and elimination of the $10,000 state and local tax cap. That's sort of better known as the SALT cap. Individuals that live in states where there's an income tax. And fortunately, that's not happening here in Florida, but there's a lot of folks that live in other states that have an income tax. They can only deduct $10,000 on their Schedule A if they itemize, and so that would be eliminated under this proposal. And I think there's a lot of momentum for that one to also to be put into law. So
both sides want that one, right?
yes, they do. Yes.
So what's the next step on these proposed tax benefits? Like, what's next?
Well, I think every president has a wish list proposal. So the president, they sort of come up with what's called the Green Book, and they sort of present that to Congress, and then Congress has to come up with a bill. Starts in the House of Representatives, then it goes to Senate, and then they work together, and then they present it to the president. So that's sort of the process. That's obviously a very shortened version, but this is only a wish list. They can't make law themselves, so they have to present this to Congress, and they work with Congress to present bills that would then implement the tax law.
Okay, so the president can't just say, I feel like doing this, and then it just happens, right?
Correct.
Okay.
Correct.
So what's the timeline perhaps on this?
Well, it has varied in years past. You would hope that they would start early in 2025 to figure this out, because the last thing you want to do is have something happen in December, which has happened in the past, where there's big tax law changes that happen in December. Sometimes it happens in the following year and it's retroactive. So to provide everyone a lot of clarity, both us and both tax individuals and tax professionals, we'd like as much time as possible to plan and implement and work with our clients to figure out sort of what's the next steps for them and how best to prepare. When they do things at last minute, it is because you're acting a certain way during the whole year, you're trying to guess what's going to happen. There's a lot of moving parts, and sometimes there's surprises, and really you don't like surprises. So hopefully they start with something early in the year and get it in place earlier in the year, or at least have some clarity so that people can plan for 2026 and beyond.
Okay, cool. So stay tuned to our webinar series on this stuff. We have quite a few of these, so we will keep you up to date as these things become applicable. So meanwhile, back to the movies. So we have now a situation. They have been downtown with the Ferrari 250, and it has been in the valet with the parking man who takes it for a joyride with his friend and runs up the odometer on this Ferrari. And so they are now in a situation of, what do we do? Cameron's dad, Morris Fry, is going to kill me, kill Cameron. And so they decide to roll back the odometer, or attempt to roll back the odometer. So they have lifted the car, and the car is in reverse, and the miles are not coming off. And so this relates to one of the myths that we hear a lot, is that people that have a job, say in downtown Chicago, and they work downtown and they live in the suburbs, that they can deduct the miles that they're commuting from their home in the burbs to their office in downtown. So Stacy is going to unpack this one for us.
Yeah, absolutely, Suzanne. So unfortunately for Tom and Morris, are traveling down into the city for work, their commuting miles are not deductible. So if your main job is away from your home, that's never deductible. Going to a second job is not deductible from your home. And when we're talking about mileage, if you're a W-2 employee, we're really talking about if you have a reimbursement plan with your employer, because again, the TCJA eliminated the unreimbursed employee expenses as a deduction. So we're really talking about self-employed people, or those people that have a reimbursement opportunity. So if Tom is working downtown in Chicago, has his regular office, but then they send him out on a project somewhere to a temporary work location, that mileage would be deductible. Or if Katie has her qualified home office and she is out showing her clients different houses for her real estate business, those types of items are deductible mileage, but it is important that the IRS does require you to substantiate that mileage. So you want to keep proper track of the mileage that you're using that is for business purposes in order to take the deduction as well. So Morris is probably on his way home right now, not able to get a deduction, but he's going to find another surprise when he gets home, right, Suzanne?
Oh, yes, he is. So, again, if you're a movie fan, Cameron, with his anxiety issues and his anger problems with his dad, he puts his foot on the front of the car and gives it a nice stiff kick. And the car, as you can see, plummets from the second story of the Fry's household. And so the myth here, which is very applicable right now to the state of Florida, is, the rumors are swirling about the ability to take casualty losses related to hurricane damage. And so hearing a lot of buzz about this, again, in Florida, it's extremely prevalent. So Cameron, again, freaking out. His dad's going to kill him when he comes home. And so maybe if it's deductible, he'll be in better shape. But Stacy, tell us if that's going to happen.
I have to say, sorry, Cameron. The one thing we have going for us is that this movie was made in the 80s, where the rules may have been a little bit different. But again, TCJA has eliminated the ability to take a casualty loss except for a federally declared disaster area. So unless Cameron's got a connection with the president, I'm afraid he's out of luck. So for 2018 to 2025, those personal casualty loss deduction is only available to that limited scope. And in order to take that deduction, you need to reduce your loss by the amount of insurance reimbursements that you receive. And it's also important to remember that you are required to make an insurance claim if the property is insured, or else you're not even able to take that loss, and it's only limited to uninsured property. In addition to reducing the loss by the insurance reimbursements, you also have to reduce it by $100 and 10% of your AGI. So this really eliminates a lot of that loss that's allowed to be taken. There is what's called a qualified disaster, which has to be named by Congress through legislation, which changes the calculation a little bit by increasing the $100 deduction to reducing it by $500, but it eliminates the AGI deduction, allowing you to get a greater loss. Currently sitting on the President Biden's desk is HR 5863, which would expand the hurricanes that we've seen over the past few years to be qualified disaster losses. So that is something that we are tracking and watching, and we will keep you aware of, so that when you're filing your taxes, you know if it's a qualified disaster or not.
All right. So if you guys remember Principal Rooney, a major player in this movie, he was the principal of Shermer High School, which is a fictional high school. But fun fact, it was also the same high school that was shown in the 1985 flick, The Breakfast Club. So the director of both of those movies were the same, and he used the same high school in both movies. So fun fact. But anyway, Principal Rooney has, turned the city upside down. He has actually gone physically to Ferris's house, and has gotten attacked by his Rottweiler, who his sister let loose on him because she thought it was an intruder, and she called the police, and you guys know what happens there. So the myth that we are correlating this with is that recently the IRS has been granted $80 billion of funding. And so is that going to go to enforcement? And if not, where is that money going to go, and what are they doing with $80 billion? So Sam is going to tell us a little bit more about that.
For sure. So the myth being $80 billion going to enforcement, that is not true. However, there is money allocated to enforcement. So in 22, the Inflation Reduction Act was signed into law, and that allocated $79.4 billion to the IRS in general. And that actually was subsequently reduced by another 20 billion. So the current funding amount is 57.8 billion. So on the right side, we can see the categories of the allocations. So the largest categories being operations support and then enforcement. BSM stands for Business System Modernization, which we as tax preparers and people dealing with the IRS, we agree they need to work on that. And taxpayer services. So the little middle section in here shows the amount that's actually been expended so far on each of these categories. And we can see that enforcement actually, we've only spent 3.4% of that amount that has been allocated by the IRS. So yeah, the 80 billion going to enforcement is a myth, but there is amounts allocated to that. And then on the next slide here, we're going to see the start of IRS exams per year by type of entity. So we have high-income individuals, partnerships, and large corporations. And we have the start of exams over the last few years, and then the target for 2024 and the target for 2025. So we can see we don't have a huge target like jumping all the way up because of that enforcement budget, quote unquote. And it's also important to note that these numbers, in 2019 being close to 6,000 for the partnerships and around 2,000 for the individuals and large corporations, it's a little hard to compare these numbers because we need to factor in the count of high-income individuals versus the count of partnerships versus the count of corporations. So we need to keep that in mind. But one other kind of bit of data that the IRS has provided is that between 2013 and 2020, the amount of examinations, 0.44% of individuals have been selected for examination and 0.74% of corporations have been selected for examination. So we see a bit higher percentage in the business entity side.
All right, so you're good there, Sam?
Mm-hmm.
Well, life is moving pretty fast, so make sure to stop and look around or you're going to miss it. Speaking of fast, another fun fact, the script for Ferris Bueller was written in 6 days, which is pretty darn fast. That is much faster than the IRS gives you to extend your tax return. So you do get more than 6 days. But we hear a lot of people are scared to extend their tax returns because they think that is going to be an automatic audit. And so we hear a lot of clients very concerned. I don't want to extend my tax return because they're going to mark it for audit, and they're going to think I don't have my stuff together and I don't know what I'm doing, and they're going to audit me. So Stacy, can you tell us if that's fact or fiction?
So this one is complete fiction. There's a lot of reasons that people may need to extend their tax returns, and the IRS gets it. There are people that have flow-through income and they can't file until they get the flow-through information to put on their tax return. So if you didn't file an extension, then you would be filing a false return. So an extension is actually a good thing because it provides you that additional time to present to the IRS a complete and accurate return. And not filing that extension and filing with missing information is a much worse scenario. It is important, though, to remember that an extension of time to file is not an extension of time to pay. So it's important for people to work with their tax professionals early in the season to be able to calculate what that extension payment needs to be so that the estimated tax liability is paid by that due date.
All right. Well, we are making good use of our time here. A couple more fun facts that we'll leave you with. If there's any questions, please put them in chat. I haven't heard any yet, so if you guys have any, feel free to put them in chat. Again, fun fact. Most of the license plates in the movie were based on other John Hughes films. So Katie's license plate is VCTN, which is National Lampoon's Christmas Vacation. Jeannie's, which is the sister. Don't forget about Jeannie. She's down at the police station right now, kissing Charlie Sheen. And her license plate is TBC, which is the Breakfast Club. Tom's license plate is MMOM for Mr. Mom. If you guys remember, he was in Mr. Mom. And Principal Rooney's license plate was 4FBDO, which is for Ferris Bueller's Day Off. So if you guys rewatch this movie, be on the lookout for some of these fun things. The other one I didn't know if I could mention just due to time earlier was Ben Stein's scene, the economics teacher, was improvised. That wasn't even in the script, and he was over there having fun with some of the extras, some of the kids, and they were dying laughing at him, and so they put that into the movie. So that whole economic tariff thing that we added earlier in the GIF or the movie is completely unscripted, and it was just added for fun on the fly. So in your packets, I'm sorry, Sam, did you have something?
Yes, so we did get a question. The question is, if you sell an investment property for less than you paid for it when purchased, can you deduct the amount in loss? So the example is you paid $60,000, you sold it for $30,000, and can you deduct that loss?
David, you're nodding, so why don't you take that one?
So, well, if that was your only transaction for the year, if that was the only transaction that created a capital gain or loss, unfortunately, you cannot deduct the entire $30,000. You're only allowed to deduct $3,000, and the rest is carried forward. That loss is carried forward. However, if you have other capital gain transactions, some other investments or other stocks that you want to sell, and you can sell those at a gain, that those would offset each other. So you could have something else that was a $30,000 gain, and that would be offset by this $30,000 loss and net to zero. But if this is your only transaction and you end up with a net capital loss after all the dust settles, you can only deduct. IRS only allows, unfortunately, to deduct $3,000, and then the rest is carried forward.
Thanks, David. Any other questions, Sam?
I will. Hi, I'm the ghost in the background. The person who asked this question did clarify. They said no gains, only transaction.
Say that one more time. David, did you hear it?
I did not hear it.
To
One more
clarify
time.
part of your answer, David, the person who asked the question said no gains, only transaction.
So if they only had this transaction, then they'd only be able to, deduct the $3,000. Now, I will also say it has to be a realized gain. You can have stocks that you hold on to that you don't sell, but they go up and down. Unrealized gains and losses are not taxed. So it's really you have to have a transaction where you sold the property at a loss or sold the property at a gain.
So it would be $3,000, assuming it was sold, that you can deduct in the year sold, and
Yep.
anything else can be carried forward and used in the future. So it
Right.
doesn't disappear, but you can't use it all in the current year.
Right. So it would be you have a $27,000 capital loss carry forward. Next year you would have a $30,000 gain that you had the next year. You'd only have a $3,000 gain that you'd have to report in the following year. So it doesn't go away. It just doesn't get used in the year that it was created completely.
Thanks, David. Any other questions?
That's
All
the
right,
only one I
well,
received.
Okay, great. If you have them, please put them in chat. We do have a couple minutes, so don't be shy. So we've got a couple things we're going to send to everyone, the webinar package here, our PowerPoint. And so we have some just information on the next few slides here that is just valuable information. And so what you're looking at here is current law, post TCJA law and then Trump's proposal. So again, if you're curious what that looks like, what his proposals are looking like from a tax standpoint, please consult our slides, not Facebook. So we've got that in here for you to take a look at. And then of course, we have our contact information here at the end. So when in doubt, seek professional tax advice. When you're curious about these things, please do not consult Facebook or Instagram or TikTok or whatever your social media of choice is. We have very much enjoyed seeing all of you today. Thank you so much for attending. There will be a short survey that will follow the webinar. So please take that now. We love the feedback. We like to know if you guys appreciate the content, the time of it, all of the things. So please give us your feedback. We love to share this kind of information with you. So any feedback is really important so we can make sure that our webinars are informative, interesting, and they're applicable to your day-to-day questions. So thanks again for attending, and we look forward to seeing you guys again sometime soon. Bye.